Welcome. This is Annuity News Now. I'm Scott Drake. Section 72 of the Internal Revenue Code generally provides favorable deferral of income tax for qualified annuities. However, Code Section 72U disallows such favorable treatment when the annuity is owned by someone other than a natural person, like a trust. But an exception allows a trust to hold the annuity as an agent for a natural person, and this is the subject of a private letter ruling we're going to discuss with tax law expert Robert Wood with Wood LLP in San Francisco. Rob, welcome back.
Hi, Scott. Nice to be here.
Annuities are nice little tax deferral products, and a trust is something else that people use in estate planning. Can you explain what this means?
Yeah, well, I think this is obviously it's a favorable ruling. It represents the IRS, I think appropriately in this case, stepping outside of the sometimes rigorous confines of the Internal Revenue Code to say, as they did in this letter ruling, this is okay, there's sort of no harm, and it is okay if you have annuities held by a trust in this circumstance. It's probably not something I would have noticed, this ruling, to be honest, but it is clearly a good thing, and certainly since many of our viewers are experienced with structured settlements and deal with annuities, it's good to know that occasionally the IRS makes exceptions, and in this case blessed the holding of annuities in a trust.
Mm-hmm. Is this just something that the IRS just said, well, this is common sense, let's just go ahead and favorably rule on this?
I think so, and I guess it brings up a larger question, which is, what does a private letter ruling mean? Tax lawyers and accountants have for decades now read private letter rulings and relied upon them, but of course technically speaking they are not authority. It's not a published revenue ruling, which is something different. A published revenue ruling is technically authority. It goes through lots of levels of reviews at the IRS, and of course case law decided by a court is binding on the IRS, and those are published authority. Private letter rulings are more informal. They bind basically the IRS to one particular taxpayer. It's basically a determination that a specific taxpayer gets a particular tax treatment. But as a practical matter, we all rely on them, and I think this will open up perhaps even more markets for annuities.
Mm-hmm. And so this isn't an actual change to the tax code. This is just an opinion by the IRS that says this is probably a good idea, but it doesn't necessarily mean that in every case, in every trust, that there's an annuity that this is going to help you.
Yeah, no, that's a good point. I mean, it is not carte blanche, but it is, and I think you say it well when you say the IRS said, well, this is probably a good idea. It's that kind of a tone, I think, in the ruling, and once again is a good thing.
Rob is principal at Wood LLP in San Francisco and a frequent contributor, if not a daily contributor, to Forbes. Rob, it's a pleasure. Thanks for taking the time.
Thank you.
And you're watching Annuity News Now.